Ultimate wealth is found in wisdom alone.
Hey everybody, Neil, John, and Robert here to talk about the effect of interest rates on bonds. Neil, why is this important?
Yeah, this affects just about every one of our clients in some way, shape, or form. Anybody who has any kind of fixed income, we use, bonds, fixed income, debt securities. There's a lot of different names for the same category of notes that are issued with a particular interest rate, which is why we typically call them fixed income.
So Robert, clients know that when they invest in the stock market, there's some risk and there's some reward. Does the same hold true about investing in bonds?
Yeah, absolutely. Now, it is arguable that there's less volatility in the bond market than there is in the stock market, but bonds definitely have their own type of risk. Bonds are debt instruments, so there's a couple of different factors that are involved here. First of all, obviously, interest rates are important. Interest rates are the cost of borrowing money, and companies and governments have to deal with that just like we do as individuals when we're borrowing, mortgage on the house or a lease or a loan on a car. Generally speaking, there's the treasury notes and treasury bonds. Those are backed by the taxing authority of the U.S. government, so they're AAA highest rating possible for bonds. Loan state and local governments can borrow money for roads and infrastructure and schools, municipal bonds. Then you've got corporate bonds that are the companies, the Googles and the Procter and Gambles of the world. And you've got, again, in the corporate side of things, you've got AAA all the way down to B and even below. Many of those lower, the lower letters are, lower credit, higher costs, higher interest rates. Those are riskier investments, so they come with a higher return. It costs more for those entities to borrow money than it does for the companies that have really good credit worthiness. Length of time that the debts are out there also impacts the cost of borrowing and the risk involved, because the longer the timetable of the debt, the more risk there is for the volatility of that the pricing and the inflation and interest rates working against you. So usually a short-term note has less risk and therefore less interest than a long-term.
Oftentimes we look at the Fed rate, so the Fed funds rate, like when the Fed changes the bank rates, the rates that the bank pays, that's one way that interest rates move. There is a correlation where wherever the Fed sets their rate, typically you see other rates move accordingly, but not always. They are somewhat different. Interest rates are going to affect, interest rate movements are going to affect high credit quality notes more so, especially the longer term high credit quality notes are going to be more affected by interest rate movements. As you move down the credit quality spectrum, like Robert was saying, with a B rated credit, those are going to be more affected by economic conditions because they're more credit sensitive. Your higher or lower credit quality notes are going to pay a higher interest than your high credit quality notes. And so sometimes it's good to have a mix of both long and short-term notes and high and low credit quality notes from different sectors of the economy as well. So I like analogies. I think they're a great tool for helping, grasp complex decisions and complex concepts. So one that I like to use, just as a simple concept, is a seesaw. So if you think of there's a seesaw, and when interest rates go down, your bond values go up. And when interest rates come up, bond values go down. So let's say that let's say, John, you owned my mortgage. I've got a fixed 30-year mortgage at 3%. Okay, you own my note, so I'm paying you 3% for owning my mortgage. Now let's say interest rates have come up and now they're 4%. Which note would you rather have? A 30-year 3% note or a 30-year 4% note?
Neil, I want that 4%.
So does the market, and so does everybody else. So if you still owned my 3% note and the market's now at 4%, if you want to sell that note to the market, what would you have to do? You're going to have to sell it at a lower cost. That's right. So you're going to have to offer it a discount, and oftentimes it's proportionate to the amount of interest that somebody would have lost over the length of the term. So if it's a 12-month note, let's just say 3 and 4% doesn't change it much. It may not change the value hardly at all. But if you had a 30-year note and a 3% versus 4% equals a lot of interest over 30 years, the value and the amount of discount that you'd have to offer is greater the longer the term of the note. Yeah, so just to kind of conclude here, everyone, on why this is an important concept to know is that if you'll see it in the news often, the Fed funds rate has changed. It does affect the value of bonds specifically, and it affects just about every client in some way. So it's something that we track, and if there's ever any kind of question on it, thought, feeling, concern, something you'd like to bring up with us, and maybe look at how much bond we have and what our credit quality is, our duration, our maturity, we can pull all those numbers up and go into it a lot more depth. So again, never hesitate reaching out to us, and we're here to help. Thanks, everyone.